following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Welcome back to the show. Hope you guys are having a good Tuesday morning. And we're going to hit some gold here really quick, first of all. And by the way, we're going to go to continuous contracts in the scanner probably today on not the beans and the cottons of the world, but the continuous contracts on the indices, the currency futures, and the treasuries. So we talked about that. We're kind of switching gears into December-ish contracts on some of those continuous, or excuse me, on some of the those indices, treasuries, and currency futures, and we're going to do that because we've got a little bit more volume to analyze, and those contracts, you know, kind of mesh together very well, and there's no reason to do the separate contracts on the front months on those. So that being said, we're going to have Steve Banger on right at the first break. We're going to talk about some of the trades we had talked about before relative to volatility and buying that volatility. If I can get my TFNN clock to work here, that'd be good. There it goes. All right, so taking a look at gold, the December contract, here we go. You know, kind of getting back into the fair auction, bouncing around and retesting that unfair high around 1333, 1331. You know, nothing to really trade on right now when it comes to gold. I mean, we're just kind of sitting at the top of the mountain here, not wanting to really fall down one side or the other. I'm a fan of trying to buy support on gold, so that's the deal there, and nothing really to play hardcore defense against right now. Here's the November beans. You know, you can roll the dice before some of these reports or announcements or news stories. A little bit of a maybe stop out some folks a little bit above that 983 we talked about yesterday, and then just kind of came off. We're actually now traversing past that 964, which was the first targets on that. Not good for bean guys out there who want to be long. Somebody had called into the show and had asked about, are beans ultimately going to be at 850? You know, anything can happen, especially in the grain market, but you know, I wouldn't totally count on that and just kind of hang on to your shorts forever here. A weekly close below 964.65 is really going to give me the opportunity to feel okay again about putting some stops above 64.65 and just letting this thing possibly fall apart. A really good way to trade these type scenarios, especially on the grain market, to not get shaken out, is to do some option plays. And you've got a lot of different options on the option plays. No pun intended, but you know, a lot of times doing something really simple. I've talked about this before. Of you know, for instance, in this case, short in the future and buying in the money calls. If you're expecting that 850 move or really trying to wring quite a bit of points out of this thing, and you don't want to really get shaken out, get stopped out a couple of times, which is a pain to say the least. Short futures, long in the money calls in this case, or, you know, just to some degree, a credit spread or two, a debit spread on the bottom. I'm just a big fan of having unlimited upside on that particular play. I talked about short futures in the money calls and really needing a bigger move. But if the market goes straight up, in that case, you kind of not paid a lot for the insurance, and your deltas are pretty high on the insurance, and it's protecting you very well. But again, you got to have a little bit bigger move on the downside to take advantage of that. So, that's a good question. Somebody's throwing it out there in the den. The question is, would 915 offer good support for beans? Without question, that's where the kind of race started that's the first, that we talked about this before, and I failed to mention it a while ago, but 915 was a big number before. And we're not using continuous contracts on beans to analyze them because you can't really, and John from Philadelphia could probably give a dissertation on this. The book of knowledge when it comes to a lot of this, it's hard to kind of mesh two contracts together like new crop and old crop beans and try to figure out, analysis based on that. So we separate these, and that 915 on these new crop beans, that level was a big level before. I mean, we kind of reversed off of it one time back in December 2015. And then when we really, and again, I'm going to reference the book of knowledge on grains. I hope he doesn't mind me saying that. John from Philadelphia had talked about really getting long down here around 860, 65, 70, somewhere down in there. And then the confirmation on that trade really happened when we got a close above 915 again, and then kind of retested it a couple of times, defended that area really well. And that's, that brings up another point, really. Trading these profiles allows me to really, at times, block out one side of the marketplace. And when we started getting above these 915 profile highs, that was when it was okay to be long, not okay to be short. So you're looking, you're kind of leaning in that direction and not trying to confuse the trade anymore, because the odds are really in your favor to try to pick the battles on the long side at that stage. So the 915 area, to answer your question, RJP, in the den, is a not, well not forgotten number. And that would be the first targets on the downside to really take some off the table. Again, if we can play defense on the short side above 964, 965, this is not guaranteed to go down another tick, by the way. So you gotta, again, always be thinking, this is my stance. You've always got to be thinking defense, because you always want to be able to go take your ball home and come back and play the next day. Getting involved with these mega trades, without any plan, if you're wrong, is you can ask me, you can ask Larry. I'm sure you can ask a lot of people in TFNN how that can work out. Not very good sometimes. So RJP, sorry to be long-winded, but yeah, that's a good number down below. And then you've also got that 850 area. While we're talking about grains, let's just hit December really quick on the corn. Haven't been bullish on this one. Have been trying to find reasons to get short this thing. Haven't really had anything to lean against on the dailies up here on December beans. So this is an example of, what was the possible easier trade relative to beans and corn, because you had a chance to play defense on the bean trade. But again, you had a report, and that's kind of rolling the dice. But December corn, 328 is a number down below that's going to have to be paid attention to. 328, 330. We're not there yet. We're going to be right back, folks, and have Steve Banger on with us.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. We're trying to get Steve on, Steve Banger. We're going to talk about some some index volatility plays again and get some of his macro thoughts on where this thing's headed. Yeah. Somebody saying in the den, I think we're going to talk about the 100-to-1 risk reward on that one that unfolded. It talked about a spread on the December, so we're going to talk about that as soon as TFNN can grab him, and we're having a little bit of a technical issue right now. You know, Skype is a great technology, but every once in a while it just kind of weirds out. It's a deplorable situation. That's a deplorable crew over at Skype. Half of Skype is a deplorable crew. You know, when she I'm sure you guys have watched the film of her trying to stabilize and get into, or they were trying to shoo her into the van. Man, she must be as heavy as a sack of potatoes. Did you see people trying to hold her up? It was, felt more sorry for them than her. God, I shouldn't have said that. Here we go. All right. So as we look at this, we're going to take a look at a couple of stocks. We obviously had a decent bounce yesterday, and we're looking at the continuous now. We're looking at the continuous contract now to get the levels, which we're converting into the scanner on the index futures, the treasuries, and the currency futures to try to mesh these together a little bit better. 2141 is a big number on the weekly. We're kind of sitting right below there. We almost got to 2065 yesterday. We talked. Juan was on the line yesterday with us, and we talked about selling rallies. This break here, this break below weeklies and dailies, and the scanner breadth in general kind of rallied back a little bit yesterday, but still has negative tones, and we kind of got near inflection points, and it was okay to be short for a change and try to sell some rallies. Still feel that way. The ultra short term, and you're going to have some wide boxes here on the 240s. I hear you, Fletch. There's that 2164 area, 65's up there. We never quite got there. The other short-term numbers, 2128, 2129 on the 240s. I'm talking about, the institutional grade sack of potatoes out in Idaho, the heavy baking potatoes in a 100-kilo sack. That's the sack of potatoes I'm talking about. Man, we have two awesome candidates, huh? It's going to be scary for the markets. Going to have some volatility based on the numbers in the political scene for sure, which is going to give us something to react on. Let's take a look at a couple of stocks. And we still don't have Steve Danger, but it's okay. We'll keep trying. Apple, you kind of got a gift here, in my opinion. We closed below. On the weekly. We rallied back up into that 105.5 area. That's the daily and the weekly. 105.5 general neighborhood. We actually reached the, what did we reach yesterday? 105.72, 105.88 is that daily on for low. So now, in my opinion, and you've got a little bit of a breach of that this morning. You got a chance, in my opinion, to get on the short bandwagon on this again. If we can get below 106, 105.88, 105.5, I think Apple, could be shorted actually. Okay, so I think we got Steve now. Steve, you there?
I'm here, John. Good morning. How are you?
Hey, man. Doing good. How are you?
It's another beautiful day. That's all I can say.
Chicago. It's like Philadelphia. Right? It's always beautiful in Chicago.
I know, at least for the summer.
Exactly.
Of course, it's going to change. So if you still have me on in like another 3 months, I'm going to start crying every time you ask me that question.
You know what? You know what's really beautiful when the weather's still good up there is going. I don't know if you've done this before, but when I was in the board with you, I'd get in my pickup truck, throw the dog in the back, and drive straight north, like up the lake there,
Yes.
and go up into northern Wisconsin, and then up to that up in Lake Superior, that Copper Harbor area. Man, that is beautiful up there.
Yeah.
When the weather's good, put it that way.
Yeah, I mean, as you know, John, I jump horses, right?
Yeah.
So I'm actually outside of the city pretty much 4 or 5 times a week, and I'm about 45 miles outside of the city, and it's very rural where I ride. So I get my dose of forest and farmlands and lakes, for that matter, pretty much a couple of times a week. So and I like it this way. So it's nice.
Yeah. Awesome. Well, I tell you what, I'm glad you're on because, some of the things you were talking about before, just I'd like to know, where some of the numbers are based on just awesome concept you had last time we were on talking about, the volatility contracting and maybe just planning for an explosion. Well, seemingly that happened. So I'd just like to get some discourse from you if possible so everybody can hear how that panned out.
Sure. So
and what might be moving forward for us here. So
yeah, that's always the question, right?
Yeah, exactly.
Who cares about the past?
Exactly. I want you to be able to beat your chest a little bit though, and then also hang yourself moving forward. So that's what that was all about. So
yeah, that's what usually happens. Very
okay.
True.
All right.
I mean, in a nutshell, Friday's move in volatility was actually the third biggest one we have had in about 3 years. So the move was rather violent, and one of the reasons why it was as violent as it was clearly because the market was stuck in a trading range for more than 40 days, which is less than a 1.75% range, which really hasn't happened in more than 40 years. So
really,
yes,
I didn't know the stats on that. That's quite amazing.
Yeah. So that hasn't happened since the late 60s, actually. So we had a 40-day range of less than 1.75%. So when the market finally broke out of it, it made this huge move. And the volatility responded, of course, accordingly. But then, of course, there's a big snapback yesterday, right? So everybody was feeling all good about it. And today the market is a little bit weaker. So everybody's, of course, now scratching their hands what's going on. And
right.
I guess the question for you and everybody else is what's going on next, right?
Right.
Yeah, for me too, by the way. I agree.
Well, what do you like in a situation like this? I mean, the buy the volatility trade obviously worked out extremely well, but are you kind of because what's kind of I don't know if you can call it fun, but neat, I guess, in trading options is when you get something that starts going your way, you can start chipping away at hedges. You can, kind of complicate the position, I guess, if it was simple at the beginning. And, try to lock in some profits and also leave the door open for some more kind of wringing more juice out of the trade. I'll tell you what, I hear the music. Steve, can you hang out for another segment?
Sure. Okay.
Great.
Yeah.
Great. We'll talk about that.
All right.
Okay.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're looking to discover a new financial resource and diversify your financial portfolio, consider the new Market Safe Focused Commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 6 equally weighted commodities, including gold, silver, copper, nickel, soybeans, and sugar, in one powerful CD. With annual pricing caps of 50% per component, you could earn up to a 50% upside payment at maturity if the commodities increase in value across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. Take advantage of this financial resource designed to grow with the times. The October 13th funding deadline will be here before you know it. So hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show, and we're honored to have Steve Banger on with us today. And Steve, we were talking about the crystal ball scenario here before we left, so take it away.
Yes. Well, I mean, nobody... You see, first of all, I have to say, I hardly ever remember what I do a day or forget about a week ago, right? But it's one of those situations...
I'm right there with you on the short-term memory thing, but go ahead.
I know. But I do remember that the last time I was on the show was right on the day Janet Yellen was speaking. on the day before Janet Young was speaking in Jackson, Wyoming. And what I did say at the time was that I clearly feel or felt that the risk in the market is to the downside, no matter what Yellen does or say. And that view is still the same. I clearly believe that the risk is to the downside, and the violence of Friday's move has, on some level, confirmed my view on that matter. I truly believe that the market is vulnerable to the downside still.
Yeah. Yeah. Did you change your mic a little bit? It sounds like you're a little distant. Or
Yes, I did. But no,
okay. That's perfect. That's perfect. Just wanted to make sure everybody could hear you properly because your words are valuable, Steve.
All right.
They are, man. I mean, geez, man, it's a great learning experience every time you're on. Well, so how to, okay, so the volatility's picked up a little bit here. There was some really good long volatility positions that you and I had been talking about. If somebody's just jumping in right now, is it worth it? Let's just say they haven't done anything. Is it worth it to try to do any type of kind of capture volatility plays right now, or is there like the directional trade type scenario that you feel might be appropriate with options on the downside? Like what's probably the what would be in your mind one of the maybe more higher probability trades to put on right now?
Well, I think volatility is going to go higher from here. The problem really is that I would say 40-50% of what is possible is already off the table. So on a lot of levels, the horse has left the barn.
Right.
So I don't really think that just a plain long volatility play would be advisable from here on out. I mean, there are other stuff people can do, but gets awfully complicated awfully quick, like ratio trades, which kind of like give you the reward when volatility spikes, but also doesn't cost you if volatility falls back. Because right now we are once again, I like to call that no man's land. Volatility might easily slide back 20%, 30% from here, but it might also easily double. And just mathematically speaking, it doesn't matter what I think where it's going, but just mathematically speaking, it's just not a good spot to put a position on, unfortunately.
On the ratio trades that you just spoke of, would that be kind of putting them on both sides, or like more kind of directional ratio, like capture?
Well,
or what do you think there?
You can actually play it from both sides. I mean, that's what I do in my own trading. I'm pretty much on both sides of the markets at all times. But what I'm specifically referring to is that you can buy at the money volatility calls and then sell out of the money volatility calls at a level which offsets the at the call premium. And the idea is that if you're wrong, the market just falls, and volatility just falls, you're not going to lose any money. But at the same time, if volatility starts to rise or continues to rise from here, the at the money call should make you money, and the out of the money call should expire worthless. And you can actually manage that process whereby you make sure that the out of the money calls never actually get into the money, so that even if there would be rather drastic rise in volatility, you still should make money. It's just that it's kind of difficult to explain over.
What do you? Yeah, and that is a complicated position. And what are you monitoring on that to try to adjust the, the ratio that could start biting you? Are you kind of monitoring gamma on that? Is that kind of like a buy a straddle and sell the ratios kind of way out, or?
Yeah, I mean, the big problem in option positions is always that they kind of tend to explode on you, right? You're short something or long something. I mean, it's good when you're long, as this position all of a sudden has that huge leverage in it, whereby it exponentially, almost like a J curve, changes in value. And that is described by gamma. So you're right. It's what's being called the gamma risk. But you can also manage that. So what I look out for in my own trading is to have stable gamma positions, which still have the leverage. So I don't have to worry about when the market goes up or down significantly, that my position becomes unstable and I have to significantly change positions. but honestly, John, it's kind of tough to explain over
A
Skype.
short conversation, yeah. I know.
It really is, unfortunately. Yeah.
I don't know if you remember this when we were in Chicago. Yeah, you didn't remember the last time that I reminded you that
Right.
you had mentioned something about these sawtooth charts because when things. I think the VIX. I want to say it was like at 6 or something. It was something crazy back then, where all the prop shops were going out of business because it was just like everything was stuck in the mud. Do you remember that? Yeah.
Yes. I mean, I think the lowest the VIX ever got was 8.94.
Ah, okay.
So it was when the VIX was trading around 10. And honestly, once it's down to that level, I mean, nothing moves. I mean, we got a taste of that prior to Friday. I mean, 40 days, a 1.75% range. It gets awfully tough to make a living for a lot of people.
Yeah, and then I was even mentioning that the financial markets have finally become commoditized, and everybody starts, oh God, this is Betterment's taking over the world, blah blah blah, and then all of a sudden it changes violently like that and snaps everybody back in reality. But one of the things that I remember when we were in Chicago, this was 15 years ago maybe. We were talking about gamma scalping opportunities, and we were talking about like what's the optimal situation for that, of buying the straddle and then being able to kind of either stop yourself out, shorten it, or buying against the straddle. And we were talking about individual stocks that maybe were in like a $15 to $20 kind of price range that had really decent movement, and those are the type of stocks, like you're talking about a ratio kind of trade on both sides, like we were talking about earlier. I remember that conversation. It always stuck with me because there was some, there were some $15, $20 stocks that had some decent movement, and you could kind of put on a straddle and then kind of scalp the underlying against it, and just kind of capture, and keep the long-term hedge going against each way.
Yeah, I mean, there's some interesting stuff you can do, right? I mean, when it comes to options, you definitely have a couple of more options than just buying or selling as straight stocks. The only problem is that it requires a lot of in-depth effort. And I honestly feel that the low volatility environment is over. I really do. I think we're going to see a significant uptick in volatility from here.
Right.
And the Fed has kind of run into a wall on a lot of issues.
Well, cool. Well, listen, man, thanks for coming on today.
My pleasure.
All right,
John. Talk to you later.
We'll be right back, folks.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi guys, welcome back to the show. Steve Banger was on with us earlier. I love talking to him. Somehow, he just has an incredible macro view, and just a lot of times we get caught up in the noise of what's happening today, like the Fed, what's happening this hour, like the Fed, and sometimes it's better to step back and just kind of get your head around, a way to kind of get through the noise. Of the normal noise of the market, and really kind of make sure you have the view of the long term, and being able to kind of just put on a option massage type long term position and just kind of wait it out. That's been my feeling on the euro. That hasn't really unfolded yet. But again, I don't want to get shaken out of that trade. So, I'm just kind of hanging tight with the short euro, long the calls in the money, and not really paying anything for the insurance on that one, and looking for a bigger move, and not really paying attention to it too often until I see the green appear in the P&L column. So, thanks again, Steve, for all that input there. And there's something to be said about keeping it simple. And when the volatility is low, it's kind of a waiting game, and give yourself a little room. He had talked about those December calls a while back, last couple of times we talked. And, again, it's like, okay, I'm going to take a little noise tick down in the position, blah, 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 blah. And then all of a sudden, what did he say? Since the late 60s, there wasn't a pickup in volatility that hard. I believe that was the date. And Basil correctly, as he did earlier, about the VIX value. I think it got as low as 9.3, and I had said something like 5 or 6. I know it was way down there. I couldn't remember. It's too far. Would that still be in the short-term memory area, Basil? I'm not sure. I lied. Here we go. Let's somebody didn't want me to look at POT, but I want to go back to the XLE in a second and look at some of the instruments in there. Here's potash. So, this one, when you get, broke my heart here. I wasn't trading this, but I hate it when this happens, when we get these closes outside these profiles and then we kind of fail. You just have to take your medicine on these and just sit tight. And the range on this, on the weekly profiles I'm looking at POT, obviously kind of been compressing into lower and lower volatility here. 1535 bottom of the box, 1759 top of the box on this one, and we're sitting right at the POC here. And this morning, it looks like we're printing 1666. Is that 3 6s in a row? Ah! All right. So, in the long term, don't see a lot of leverage here. You've got something you can play defense against on the POC. But, this particular stock doesn't have a lot of beta with the market right now. And here's the daily. And who asked that question? Mike? I don't know if you're thinking about shorting or going long. I think you just got to wait for breakouts outside this range either way. I mean, it's kind of a crapshoot in here. Been long, am long. Okay, I get that now. So, you could look at this optimistically as it's in a kind of a basing action and this double, triple bottom, blah blah, all that kind of jazz. But the fact of the matter is, it's just kind of stuck in a range, and it could break out either way, in my opinion. So, did it come down with the this is the weekly on this. I think you got better things to spend mental capital on right now. That's kind of my thoughts here. I don't think you have a lot of leverage here. Just had a merger with AGU. And I guess that was that some of the volatility yesterday afternoon? Yeah, I'm not that familiar with it. So that's my take on it. Hold on, guys. All right. Yeah, we had a big spike last week. I see that. I thought that maybe I haven't been keeping up with this. Okay. All right, XLE. So let's go back to the XLE chart here for a second. And I haven't been exactly bullish on crude, but the XLE's been hanging in here. And this is what I want to point out. This 6903 weekly unfair highs, and then the daily unfair lows, 6902. So caught a nice bounce off of there when and we had the daily profiles edge up higher on the XLE. So it's good to let the market come to you and pick battles around, especially when we have a confluence. I love that word, a confluence of inflection points on two different time frames. And I kind of focus on the weekly and daily inflection points a lot on this show, because talking about the 240s and the 60s, a lot of times they're kind of moot points, even during the same day later on. So we talk about these longer term inflection points, and it's nice to see this thing kind of bounce off of there. And what does this mean moving forward? You've got another inflection point up top, 7152, but you've also got some instruments within the XLE, which we've talked about, that have been kind of showing themselves early. Here's our little friend SWM. But there's quite a few other instruments in here that we're holding up. And if you get the scanner, you can kind of see what these things mean relative to profiles. I think we looked at COG lately. Yeah, kind of sticking his head above weekly profiles again. There's some decent opportunities in there. Let's take a look at the XLF. Pretty big snapback yesterday. So 24.23. Who knows if they're going to raise rates or not. Obviously, these financial companies love a widening yield curve. This morning, it looks like we're printing about 24.07. So getting back down below this 24.23, that's what I'd base my shorts against right now, to try to ultimately hit 23.58 in this ETF, playing defense again above 24.23. Let's take a look at the XLU. All right, so no prints yet this morning, but I'm not so sure we're not going to bounce again and continue to head higher off 49.37. It's somewhat of a mixed bag with the Fed right now. You never know what they're going to do. Nothing's locked in. Let's take a look at the consumer staples. And the reason I'm talking about a long on the XLU is the notes and bonds aren't acting that bad. The XLP, this consumer staples, caught a pretty good move, getting back above 53 yesterday. We're going to talk about that a little bit more when we come back, folks.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
My name is Steve Rhodes, author of Mastering Probability and host of the Trader's Edge Show, heard daily here at TFNN.com. On Wednesday, September 14th at 5 p.m., I'll be hosting a special 1-hour event, The Ultimate Reversal Patterns. I'll teach subscribers how to identify and trade market tops and bottoms. You'll learn Tom DeMark's TD Setup, TD Sequential, and TD Combo. Plus, I'll show you how to identify Gartley buy and sell patterns, which means you'll learn how to master the D point of any A to B equals CD pattern. More importantly, I'll teach you the most powerful pattern of all, by price relative strength divergent pattern. These patterns work for stocks, for ETFs, future contracts, currencies, and these patterns work on every time frame. By signing up for Mastering Probability right now, you get the first month of my newsletter service for only $49, and that includes Wednesday's Ultimate Reversal Patterns webinar. This $49 offer is only good through September 14th, so act now. At only $49 for your first month, I guarantee this is an investment that you won't regret. For all the details of the upcoming workshop and reserve your seat today, visit the front page of TFNN.com now.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, welcome back to the show. We had Steve Banger on earlier. We're going to try to have him on again towards the end of the week to expound a little bit more on the volatility plays. You know, a certain part of your portfolio, or it's good to spread the risk out. Not all your eggs in one basket. Trade the S&Ps intraday as your only source of trading. Having some longer term views and some, most big money's made overnight. Day trading's pretty hard gig. I will admit that. There's definitely some edge you can get to it, but having some of these longer term plays, and look at the long term investor usually wins, except in 2008, of course. But having some longer term plays in force is never a bad thing. It's just kind of part of the equation. Let's take a look at a couple of currencies here. Canadian dollar getting a little weaker, going up. Euro is just stuck. I hate that thing. The British pound coming off a little bit here. I'm looking at this, trying to look at this 132.53 area of support with a little bit of noise on the British pound. It's getting a little tough to look at it that way today. The yen trade. And this is why, again, I'm kind of bullish on the dollar. Seems like eternally 101.34, the yen trade. This is why it just pays to wait until we get into these areas where you can try to play defense against, like the yen trade on this daily unfair low. We reached a low of 101.42, and that unfair low is 101.34, and we're bouncing about 100 pips there. So again, nice risk rewards. Just kind of be patient, let the market come to you type scenario. Here's the dollar. Again, we're going to go to some continuous contracts on the indices, treasuries, and currency futures. I hope by tomorrow it'll be in the scanner. So dollar support at 95.19, 95.20. Stops below there. Looking for this thing to revisit at least 96.24 on the dollar trade. Okay, just checking the DIN. All right. Got about a minute and a half left here. So want to go over a couple of stocks. I was looking at Walmart earlier. This is something that, obviously kind of the horse got out of the barn back in January, broke stride. Man, that fits together well. Again, got above profiles, went back and retested. And then it's kind of been, block out the short side, block out the short side. Got a nice little market come to us, kind of trade the bounce 70.62 yesterday or this week on the pullbacks, and defended it quite well. I think the market could continue to kind of stale out down here. So you've got to be aware about getting long in a big way right now. But again, we're always trying to find stocks that are in an uptrend, finding support, being able to play defense. And then on the short side, you had some stocks that just didn't cooperate yesterday. Let me pull this back up. And let me pull up breakdowns. And is that true? Yeah, we had one stock meeting that criteria yesterday. VIP. Ouch. Yeah, news related. Guys, stay tuned for Larry. We'll be back again tomorrow.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.